Hello everyone, this is Dr. Paz. In this video, we'll take a closer look at Chapter 14, Income Tax Reporting. This chapter focuses on how companies reconcile financial reporting income, what we call book income, with taxable income as determined by tax laws. We'll also explore deferred taxes, valuation allowances, and how tax disclosures provide important insights for financial statement users. Let's begin with the key learning objectives. This chapter helps us understand the difference between book and tax income, the nature of temporary versus permanent differences, and how deferred tax assets and liabilities arise, and how tax expense is determined using interperiod tax allocation. We'll also review the impact of the 2017 Tax Cuts and Jobs Act, valuation allowances, and how tax note disclosures improve analysis under both US GAAP and IFRS. Book income is designed to measure a firm's overall financial performance. It reflects increases in the firm's well-offness. It includes all earned inflows of net assets, even if they haven't yet been converted into cash. By contrast, taxable income follows the constructive receipt and ability to pay doctrines, meaning the timing of taxation generally aligns with cash inflows and outflows. Deductions are typically recognized only when expenses are paid or when losses actually occur. Because book and tax rules differ, temporary differences arise when income or expenses are recognized in different periods for financial versus tax reporting. These differences reverse over time. Permanent differences, such as non-deductible expenses or tax-exempt income, never reverse. Understanding these differences is crucial to accurately compute deferred taxes. To resolve timing mismatches, accounting standards use interperiod tax allocation. This ensures that tax expense reflects all obligations related to the current period's pre-tax income, even if payment occurs later. For example, accelerated tax depreciation creates lower taxable income in early years and higher in later years, so we record a deferred tax liability to balance that timing difference. Deferred tax liabilities represent future taxes owed because of temporary differences that increase taxable income in the future. Conversely, deferred tax assets arise from items like net operating loss carryforwards that reduce future taxable income. Both are essential to matching tax expense to the period in which related income is reported. When there's uncertainty that a company will realize the benefit of its deferred tax assets, a valuation allowance must be recorded. Changes in tax rates, such as those introduced by the 2017 Tax Cuts and Jobs Act, can significantly impact these deferred balances, altering reported tax expense and net income. Tax footnotes provide critical information about a company's effective tax rate, uncertain tax positions, and the composition of deferred tax accounts. Analysts use these disclosures to assess earnings quality and forecast future tax obligations. Under IFRS, certain presentation and recognition rules differ slightly from US GAAP, but the underlying principles are consistent. To summarize, book and tax income serve different purposes and follow different timing rules. Deferred taxes reconcile those timing differences. Understanding tax disclosures enhances financial statement analysis. This concludes our overview of Chapter 14. In your reading and homework, pay close attention to how deferred tax liabilities and valuation allowances are computed. They're essential concepts in understanding the relationship between accounting income and taxable income. Thanks for watching, and I'll see you in class.